Hi friends, welcome to BFM Chalisa. Now only few hours are remaining for the exam. So I'll be covering mainly numericals and some theory portion. Follow the forex numericals very properly. Don't miss these. Okay. So without wasting the time, I'll move on. Okay. Because these numericals you'll see it in the exam. Immediately in some hours you will be facing the exam. Okay. A customer request to book a forward contract for retirement of an import bill of USD 1 lakh. USD amount is 1 lakh. Due for payment on 15th September. See the due for payment on 15th September. It is from your Macmillan book. Huh? So due for payment on 15th September. Given spot rates are USD INR is 75.2729. Forward premium is given as spot June 10-12, July 21-23, August 30-34, September 43-45, August to September. Now this is a bit tricky part. August to September means 15 September. It is 6-7. So for that 15 days also the forward points are given. Plus one more point, check this. Charge margin of 0.2% on the spot rate. Kindly remember. Try to solve this problem. This is a sure problem in your exam. Be sure about it. You'll be definitely getting this numerical in the exam. It's a big 5 marks case study. Okay? So, let's start. Firstly, understand what is the case. Booking a forward contract for retirement of an import bill. Kindly note few points over here. First is import bill. Whenever you have import bill, you have to take the right side, this side. Number 1. Number 2, due for payment on 15th September. So it is in the mid of September, right? Then charge margin of 0.2% on the spot rate. Margin of 0.2%. Got it? So let's start. There are two twists in this problem. Two twists. Which are the two twists? Number one is margin is to be charged on the spot rate. This is first twist. Generally, in any numerical, we charge the margin on the end rate which we get. End rate. But here, the margin is to be charged on the spot rate. Number 1. Number 2 twist is August to 15 September forward rates are given. So when such thing is given, you cannot use buy low sell high concept over here. Whenever you have the exact rate, not to use buy low sell high. This is very, very, very important concept. Whenever you have an exact rate on certain date, any date, whenever you are having the exact rate, you should never ever use the buy low sell high concept. Never use it. Got it? So with keeping these two in mind, let's move ahead. And always remember 6-7 means what? There are two digits 0607. Now kindly note, we are focusing on import bill. So we'll be focusing everywhere on the right side, not the left side. See this. This is always buy, this is always sell. Okay? Have I written it somewhere? Let me show you. See, whenever you have like this side is always buy and this side is always sell. Okay? So now we are focusing on import. Import means sell. Import is always sell. Okay? And export is always buy. Export is always buy. So now we are focusing on import. So we'll be focusing on sell part. So everywhere you'll have to look at is sell part. Right side, right side, right side. No left side. So what are the 3 points which we should focus? One is right side. Second is margin on spot. Third is this August to 15 September. So let's start now. Move ahead. Say this. Let's say this date is anything. We don't know the date. Let's take it 1st June. This transaction is happening when? Forward rate. This forward transaction is happening when? September 15th. So I have to book the rate for September 15th. Okay. I have to book the rate for September 15th. Now, whenever I have to book the rate for September 15th, I'll have to see two parts. One is September 1, starting of the month and ending of the month. So, September 1, starting of the month. That month, don't focus on any other month. If you want September 15th, focus on September start, September end. Okay? So, here, September start, September end. Now, what is the rate for September start? Now, one thing you note, if you look at the rates given over here, see these rates. Spot of June is given, July is given, August is given, and September is given. So, I want now September 1 rate. September 1. So, kindly note one point. Whenever you want beginning of any month, the rate is of the earlier month. Whenever you want beginning of any month, the rate is of the earlier month. Because when I say July rate, it means it's for the July end. When I say August rate, it means it is for the August end. When I say September rate, it means it is for the September end. Getting this? Okay, I'll ask you one question now. Suppose if I get a rate for November rate is given. So when will that November rate be applicable? At the beginning of November or at the end of November? Type in the comment section. Will it be at the beginning of November or will it be at the end of November? Where is it? Yes. Everyone, think over it. Just now I gave you the hint also. The whole idea I gave you. It is always at the end. Okay? End. Now one more question. Now suppose if I want, look at this only. Suppose if I want the rate for 1st of July. I want the rate for 1st of July. Which rate will I take? 1st of July. See this, June end is given, July end is given. But where is 1st of July? 1st of July will be earlier month. So, June end will be equal to 1st of July rate. Pay attention everyone, very important part. June end will be equal to 1st of July rate. Okay? Now, I'll ask you one question. I want the rate for September beginning. September beginning. So September beginning means what rate will it be? August end, isn't it? August end. Look at it. September beginning, it will be August end, right? So I'll take August end rate. What is August end rate? For that, what I have to do? Let's write the forward points. What are the forward points? So forward points over here, August end rate is 32.34. What do you mean by 32.34? Right side cell is 34 points. So it is taken to be taken in 0.34. Now is this currency in premium or discount? See, whenever you have right side bigger, this 34. Whenever you have right side bigger, see, I'll show you over here also. Whenever if you have right side bigger, right bigger, right, okay, right bigger, big, this is small, then you say the currency is in premium, okay, and whenever it's reverse, left side is bigger, right side is small, then you say the currency is in discount. What is the advantage and what is the use of premium and discount? Whenever you have the currency in premium, pay attention, whenever you have the currency in premium, you have to add it to the spot rate. See this, you will have to plus this, add it to the spot rate. Pay attention everyone, whenever you have the currency in premium, you will have to add it to the spot rate. whenever you have the currency in discount, you have to subtract it from the spot rate. Very clear concept should be there in your mind. Okay? So now move on. With this, let's move on. So now look at it. August end rate I am having. What is the spot rate now? 75.29. How do you know the spot rate? See, it's given. USD spot is 75.2729. Okay? So take this 29. Why 27? Because 27 is for sale. For export, buy. I want sell now, import. So 75.29. Alright? So 75.29 plus 0.34. Why plus? Because just now I told you currency is in premium. So I'll be adding this 75.29 plus 0.34. Add these two. Add these to everyone. You must get this answer as 75.63. Do it practically also. Everyone do it yourself. In exam, if you have practice on the calci, it's very easy. If you don't have practice on the calci, very difficult. Try this everyone. Practice on the calci, everyone. So it is 75.63. Okay. Now there is the twist which I told you. The twist is they have given the rate from August end to September 15th. So this is given to you. So this is what 07, right? 0607. Say this 67. So take this 7. Why? Because we are focusing always on this sell side, import. So do it 07. Now what will I do for this 07? Add or subtract? Again look at it. Is the currency in premium or discount? Say this 67. Right side is bigger. If right side is bigger, what does it mean? It means the currency is in premium. So again I'll add it. Right? Clear? So I'll add this now. See this 75.63 plus 0.07 plus. So what will I do now? Plus 0.07. So 75.70. 75.70. So what have I done up till now? I have completed the forward rate point. Forward rate, whatever is that, I have completed it. But there is still something remaining. That was a twist, right? Margin. Generally, now let me clarify this point. Generally, whenever we calculate the TT margin, this TT margin, in this problem, what is it given? Say this over here. Margin is to be calculated on the spot rate. It's clearly mentioned. Generally, we don't do this thing. We don't do it. Generally. Okay? Generally, what do? We calculate it on this last rate, 75.70. Generally, we calculate it for 75.70. Whatever you have achieved at the end, TT margin will be calculated on that end rate. But in this problem, it's specifically mentioned. Calculate the TT margin on the spot. So this is a spot. So 20%, sorry, 0.2%, okay, into spot. 20% is a huge amount. So 0.2%, 0.2%, so 0.2 divided by 100. Okay. So 0.2 upon 100 into 75.29. Multiply this, you will be getting it as 0.15. 0.15. Everyone try this. Everyone should try this. Everyone must know this. How to solve it? All of you should try this. Okay? So, 0.15. Right? 0.15 got it. Now what will you do with this 0.15? Will you add or subtract? Whenever you are selling anything, you have to add the TT margin. Whenever you are selling anything, you have to add the TT margin. Okay? Why add? While selling, why do we add? And while buying, we subtract it. Why do we add it while selling? Do you know? Okay, I'll give you a simple example. Suppose if you buy a fridge, a refrigerator at your home, you buy it from that showroom guy will send some vehicle, right, to your home. The showroom guy will send a vehicle to your home. Some vehicle will be there. So what will that showroom guy tell you? See, the cost of the fridge is, let's say, 35,000. This carting logistics person will take from you around 500 rupees. So 35,000, this 500, he is adding it to it. Is he subtracting the carting charges? No, he is adding it. Why? Because he is selling. So always while selling, you will try to add whatever this expenses have been occurred. So this is an expense. Logic is simple in all the businesses. You do it refrigerator selling or you do it dollar selling. Expenses seller, the one who is selling it, will always try to add the expenses so that he doesn't have to bear it. If this is not added, then the TT expenses, the seller or the bank will have to bear it. Right? So that's why we always add it while selling. Now add it then. 75.70, you got this answer, plus 0.15. So it is 75.85. This much is the rate to be quoted to the customer. This much is the rate to be quoted to the customer for the import. Okay, for the import. So, suppose if I ask you what is the amount? What is the amount? I'll be this, it will come. So, it is 75.85 into $1 lakh. Why 1 lakh? Because see this, $1 lakh are over here. Retirement of a USD, 1 lakh. Okay? Got it, everyone? Clear? Clear, everyone? So now, let's move on. Let's go for the revision. Some important parts of the over here in this numerical. Let's go for the revision of those. What are the important parts? See this. I'll write it over here. Okay? Let me write it over here because you must know these. It shouldn't happen that you forget it later. You must know all these. Okay? Let me bring in a new slide. Okay? See this. So what are the important points? Let's cover those. Okay? First one. Whenever you have to export, you will always sell. Okay? And reverse, I won't write the reverse thing now. If export is sell, then obviously import is buy. Clear? Whenever you have to do the export, you have to sell. Number one. Number two, forward margin. Forward. Okay? For forward points. You should use buy low, sell high when you don't know the rates in between. Whenever you have to do in between month, use buy low, sell high. BLSH, I'll write it. Buy low, sell high. If it is on the first date or the last date, no buy low, sell high. Clear? Number three. Same. Okay, I'll write under this only forward points. If your currency is in premium, then add the margin, add the forward margin, add. Okay, if your currency is in discount, then subtract. How it is in premium? How is it in premium? It will be in premium if the right side is bigger. That I told you. TT margin. Whenever you are selling, you should always add. Whenever you are buying, you should always subtract. Don't forget these basics. What is given? Spot rate is given as 35.6065. Forward for 1 month is given as 3500 and 3000. 2 month is 55 and 5. 3 month is 85 and 80. Transit period is given as 20 days. Exchange margin is given as 0.15%. Calculate the bill buying rate. It's a buying. Buying means export. Kindly note. Whenever you have a buying rate, kindly note it's an export transaction. Okay? Export. So now, how to solve a forex problem? Kindly note. While solving a forex problem, you have to focus on 3 aspects. One is buy and sell, whether it's buy or sell. Second is forward margin, and third is exchange margin or TT margin we call it. So it is always buy or sell. Kindly note these points. First is buy or sell. Buy or sell. Second is forward margin. Forward margin. And third is exchange margin. Exchange. Exchange margin. Okay? So kindly note these 3 points you must never ever forget in any forex problem. You must start in the same sequence only. Now the basics of forward margin and exchange margin, you must know this. What is the basic of forward margin? See, the basic of forward margin is if the currency is in premium, you will add the forward margin. If the currency is in discount, you will subtract it. Clear? Yeah. Earlier also I have cleared this. Basic of the exchange margin. Whenever you buy any currency, you will subtract it. Whenever you sell any currency, you will add it. This is the only basic. So you have to remember these basics. Okay? So now let's move on. What is given? Spot is given 35.6065. What is next? Forward is given 1 month, 2 month, 3 month. That's it. Transit period is given as 20 days. Now this is a real catch. This will decide what I have to take, whether I have to take 1 month or 2 month or 3 month. This will decide. So now, let's look at this. This is spot. Spot means today. Spot. Okay. Transit period is given as 20 days. So when I send the documents, it is taking 20 days. So 20 days, 20 days. Now, this 20 days will lie between what? 20 days will lie between what? 0. Spot means 0. And 20 will lie between 0 and 30. Why 30? Because we are focusing on 1 month. This is our target. 1 month or 2 month or 3 month. Month means 30 days. So, we are focusing on 0 to 30 days, 1 month. So, I'll lie somewhere over here, 20 days, 20. Okay. So, now, my focus point should be spot rate and 1 month rate. This 2 month is of no use to me. This 3 month is of no use to me. 0 use for me. 2 month and 3 month, 0 use. Got it? So, got it everyone? Clear this point? Spot and 1 month. Why? Because I'm only focusing on 20 days. This margin we'll see it later. First, let's solve first these steps. Buy or sell. First, it's already given buy. So, forget this sell. So, buy clear. Now, forward margin. Forward margin for this, we are doing this. What is the 1 month rate given? 35.30. So what does this mean? Forward this currency is in premium or discount? 35.30. Right side is lower. Whenever you have right side lower, the currency is in discount. Discount. Okay, currency is in discount. Discount means minus. Just now I told you minus. Currency is in discount. Okay. So, which rate will I take? 35 or 30? Shall I take 35 or shall I take 30? I am buying. Buying means always left side. So 35 point, this 35 and 30, right? So I'll always take, this is always buy and this is always sell. Okay? So I'll take this rate now, 35. So I'll write it over here, 0.35, 35. Let's write it in points. And what is the spot rate? 35.6. 35.60. Spot is 35.60 and 1 month is 0.35. But that is minus, kindly note, because it is in discount. It is in discount. So, first find the rate. 35.60 minus 0.35. So, 35.25. Right? This is my new rate. 35.60 minus 0.25. So, 35.25. Right? Got it? Getting this, everyone? 35.25. Now what have I to do? I am dealing in 20 days. Here I am dealing in. Whenever I am dealing in between, I'll have to use the concept of buy low, sell high. Buy low, sell high. Kindly remember, buy low, sell high. Okay, buy low, sell high. This is the concept you will be remembering. So you are doing what now? Are you buying or selling? You are buying. So forget this sell high. You will only focus on buy low. You will focus on the lower rate now. Which is the lower rate over here? Tell me. Which is the lower rate over here? Yes. Which is the lower rate over here? Lower rate. 35.60 or 25? It is 35.25. So this rate I will take. I will not take this rate now. 35.60 will be cancelled. Buy low. I will buying at a lower rate. So 35.25. Got it, everyone? So now where have you come in these three steps? First step is gone. Second step is gone. Forward margin. This answer is for the forward margin. Now what is remaining? Third, exchange margin. Now focus on the exchange margin. What is the exchange margin? 0.15%. This exchange margin you will always have to calculate on the last rate. Whatever you have got. Only if the problem says that calculate it on spot rate, then calculate it on spot rate. If the problem says. Otherwise don't. Okay? So, solve this now. For finding the exchange margin, what you have to do is exchange margin. Look at this. Exchange margin. Exchange margin, MRG, okay, equals to 0.15%. Kindly note, 0.15 upon 100 into, what is the latest rate? 35.25. 35.25. So what is the answer now? Do this, everyone. 0.15 upon 100 into 35.25. Do this. 0.15 upon 100 into 35.25. So what are you getting? 0.052. Are you getting this? Everyone give me the answer. Are you getting it? 0.052. 8 is also there. Take only 2 points. Chalo. 0.052. 8 is also there. Leave that 8. So now, do we have a page? Yes, we are having the page. So, now TT margin is, see this. What was my rate? Rate was 35.25. Rate. 35.25. And what was that margin? TT margin equals to, it was 0.052. 0.052. You are doing a buy transaction, buy. You are buying it. For buying, what did I tell you? TT margin. TT margin is always minus. For buying, you will have to do the minus. So minus this. 35.25 minus 0.0525. Do it, everyone. So you must be getting it as 35.19. 35.19. So this is your latest answer and final answer. This is the rate quoted to the customer. This is the rate quoted to the customer. Got it, everyone? This will be the rate you will quote to the customer. That's why forex numericals are difficult. It is step-by-step process. It's like this. What Netflix series is there? Every time new character comes in. First buy or sell, then forward margin, then this TT margin, then the complexity is in that. Right side, left side, bigger. Right? It's same as your Netflix series. Okay? Got it, everyone? 35.19. This is the final rate. Answer. This is your answer, because you are always asked in the exam, find the bill buying rate. That's it. Okay? Next. TT buying rate for inward payment of USD 2,50,000. If the interbank rate is 49.0002 and margin to be charged is 0.08%, find the rate to be applied and amount credited to the customer's account. Now, two things are asked over here. Rate and amount. Both are asked. In earlier problem, only rate was asked. Here, rate and amount, both are asked. What is given? TT buying rate for inward payment is this. If interbank rate is TT buying rate is given 49.0002. Amount is 2,50,000. Margin is 0.08. Now this margin means what margin? What is this margin? This margin means TT margin or exchange margin. See, both names are same. TT or exchange. TT margin or exchange margin, both names are same. Follow the same sequence again. Don't change the sequence. First, buy or sell. Buy or sell. First one. Second, forward. Forward margin. Third, TT margin or exchange margin. TT. Okay? These are the three steps. Everyone try this now. Try this. Let me see. How many of you can solve this? Let me see. Try this. First tell me, is it buy or sell? First tell me, is it buy or sell? Is it buy or sell? Inward payment. Inward. Whenever you are having inward payment means always buy. Whenever your currency is coming in, dollar is coming in, you will always buy it. Okay? So, inward means buy. So, you will cancel this sell now. So, you will be using buy rate now. Whenever we say use the buy rate, immediately cancel the right side. See, I have told you earlier also, buy and sell. Right side is always sell, left side is always buy. So, here I am buying it. So, cancel this sell. Right side, everything cancel. So, your rate becomes what? Rate over here, interbank rate is 49.00. So, bank rate equals to 49.00. Okay? So, this is the spot rate. Spot. But what about the forward? Where is the forward rate? I have given forward. Buy or sell, done. Forward rate. What about the forward rate? Who can tell me what is the forward rate over here? Which one will I take as a forward rate? Think, everyone think. Which one will I take as a forward rate over here? Yes? Which one? Forward rate. There is no forward rate over here. No forward. It's a spot transaction. Spot means there is no forward. Cancel this. Forward. There is no forward rate. Now TT margin. TT margin is there. 0.08. So margin equals to 0.08%, right? Percent only into 49. So do this. Percent means divided by 100. So 0.08 upon 100 into 49. So get the answer, everyone. What is the answer you are getting? 0.08 upon 100 into 49. So point into what is this? 49. What are you getting? 0.08 upon 100 into 49. What are you getting? I am getting it as 0.0392. 0.0392. I am getting this. Now what do I do with this margin? Are you getting all this? 0.0392? Are all of you getting the same answer? 0.0392? Getting it? Then it's okay. So margin is 0.0392. Type yes in the comment section if you are getting it. Everyone, type yes. So now what will I do with this margin? Will I subtract or add? What am I doing? Buy. I am doing buy. Buy means margin is comment section. In the comment section, buy means margin is subtracted. So rate equals to final rate. Final rate equals to, what was it? 49. 49 minus 0.0392. Do this, take this. So 49 minus 0.0392. So 48.9608. Are you getting this? 48.9608. This is your final answer. Final. Okay, for the rate. See, this is for the rate only. Rate. Okay, this is for the rate. Kindly note this. This is for the rate only. Getting it? Final rate is this. But you have been asked two questions now. Which are the two questions? Second question is amount. What is the amount? Amount is simple now. For calculating the amount, just multiply it with this dollars, 2,50,000. Rate with dollars. So amount equals to amount. What is that? 2,50,000. Okay. So I'll just write it what? 2,50,000, 2.5 lakhs, right? So dollar 2.5 lakhs into, what is the rate? 48.9608. 48.9608. Get the answer. 2.5 lakhs into 48.9608. Do it, everyone. What are you getting? Rupees 1 crore 22 lakhs 40,000 and 200. This much is the amount to be credited in the account of that customer. 1 crore 22 lakhs 40,200. This much amount will be credited in the account of that. First, have a look at it. Kindly note, whenever you deal with LC, letter of credit, you are actually dealing with three flows. Three. Okay, three flows. Which are the three flows? Say this. One is LC flow. Second is documents flow. Documents, docs. And third is money flow. Okay? You are dealing with LC flow, then documents flow, and then money flow. Remember, these are the only three flows. I mean, these are the movement. Flow means what? Movement. movement of one to another. So LC moves, documents move, and then money moves. And sequence is also the same. Sequence will also be and not be changed. The whole thing is covered under UCP 600. UCP DC we call it. Uniform Customs and Practices for Documentary Credit. UCP DC 600 is the latest version. Okay. All of these are governed under UCP 600. Got it? And ISBP. ISBP means International Standard Banking Practices, but main is UCP. ISBP is based on UCP. Okay? UCP is the base and ISBP is based on UCP. It is a supporting document to UCP. So these two documents are the main ones, okay, on which your whole LC process works. Now, let's start with first flow, LC flow. What happens in LC flow? Firstly, understand what is LC, letter of credit. Letter of credit comes in picture when the buyer and seller don't know each other. When the buyer and seller don't know each other. Okay? So what happens in this? There is a buyer over here, let's say in USA. There is a seller over here, let's say in Bharat. Okay? So they don't know each other, but they want to do business with each other. Business is to be done because this guy is exporting by Indian person and this USA guy is importing. So how will they deal with each other? For dealing with each other, what will they do is first they'll contact each other through email, through phone, anything. And then they'll exchange their discussion first. What are you going to sell? What am I going to purchase? What will be the rate? How is this documented? This documentation happens through this part. See, this buyer will give the purchase order. Purchase order to the exporter. Let's see, I want this. These 10 items. Okay? Then what will happen? This seller or the exporter. See, there are three names. Exporter, seller and beneficiary. 3 names for this person, 3 names for this person. Importer's names are importer, buyer and applicant. Okay? So, what is this applicant and what is this beneficiary? That I'll explain. Buyer, exporter, buyer, importer, seller, exporter, that much you understand? Simple. Exporter means the one who exports or seller. Reverse is the case over there, vice versa. So, they'll exchange this. First, he will give the purchase order. Buyer will give the PO. Based on this PO, this seller will give the quotation. Right? This is my rate. So, this quotation is called as pro forma invoice. Pro forma, or you call it provisional invoice. Two names are there. Pro forma invoice or provisional invoice or quotation. Any of these three names can move on. Generally in international trade, we follow the name of pro forma invoice. 99% we follow pro forma invoice. Somewhere it's provisional invoice, somewhere it's quotation. So now understand, this buyer is having two documents. What? Which one? One, his purchase order, which he has given to the seller. Second, the pro forma invoice received from the seller or exporter. With these two documents, this buyer will go to his bank. This bank is called as issuing bank. Purchase order plus pro forma invoice. With these two documents, this buyer will go to his bank. This bank is called as issuing bank. Now, why is this called as issuing bank? Because look at this. The reason is this bank is going to issue the LC, letter of credit. Now, firstly understand what is LC. Letter of credit is a bank-to-bank document, bank to bank. Why is this document there? See, the main reason I'll tell you. The seller does not trust the buyer because he doesn't know, he or she doesn't know that buyer. Okay? So seller does not trust the buyer, whether the buyer will pay or not later. That is the main problem. Second, buyer also does not trust the seller. whether the seller will send the quality goods or not. It may happen seller may sell the inferior goods. It can happen. So in this case, both of them don't trust each other. For that, what happens? They prepare a document from this bank. Now this bank, issuing bank, it prepares a document stating some 10 conditions, 5-10 conditions. I want the goods of this quality tested from this lab. See, whatever you want, you have to put it in document over there. You just can't say, I want good quality goods or I want the best quality goods. What is best quality? Best quality for you might be worst quality for me. So if I want some XYZ quality, I must mention, I want the quality of A plus tested by the lab named so and so at the place so and so. I'll mention it that way. So now what happens? It is very particular. You can't give a vague answers or vague things. Okay. The documents should be sent by the best courier, A1 courier, best quality courier. What is this? Best quality for me may not be, maybe the worst quality for you. Depends. So this issuing bank will prepare an LC, letter of credit. This LC will state all the terms and conditions, all of them. Whatever is required in details, every line. Nothing is vague. This LC now, once it is prepared, now what does this mean? It means that this issuing bank is giving the guarantee of payment. Now the buyer is not concerned with it. This issuing bank is giving the guarantee of payment. Means this issuing bank is telling this seller, this person, that if you send me the goods, if you send me the documents, not goods, if you send me the documents as per my conditions, I will pay you. Forget this buyer. I will pay you. Okay? Forget the buyer. So now what happens? This beneficiary or the seller can trust the bank because bank is a big institution. So this seller or exporter will trust this bank and this document. But now the problem is, how will this document reach? See, this bank is in USA. This person is somewhere in, let's say, West Bengal or Mizoram, somewhere over there. Some district place, some village place. How will it reach there? Because this foreign bank, let's say Citibank. Citibank can't have a branch in Mizoram or any village. So what will it do? It has to send a document. Ultimate aim is what? This issuing bank has to send a document to this beneficiary, seller. So what happens over here? This issuing bank appoints an agent in the country of the exporter. In the country of the exporter, or most probably, if possible, in the city of that exporter. Okay. So which will this agent bank be? That bank is called as advising bank. What is the role of this bank? The role of this bank is simple. Issuing bank will send the LC via SWIFT, either SWIFT or any other means now. Now SWIFT is also means they are planning to remove SWIFT in some period, some months. Okay. So if the SWIFT is removed, we will be having some other technology. ISO they are planning, ISO. So whatever it may be, whichever technology. See, this LC will, this issuing bank will send it via SWIFT presently to this advising bank. What is the role of this advising bank? The role of this advising bank is twofold. Two. What are the roles? It checks the authenticity of the LC. Authenticity. Now what do you mean by authenticity? Whether this LC is fake or true. It can happen. In international trade, there are lots and lots of transactions which appear fake. So, check the authenticity of the LC, number one. And number two, forward all the pages, complete document till the end of the document message. See, whenever you receive any SWIFT or any technological document through technological means, there is always a line called as end of the document. You see, in your old movies, if you see those military movies, there the bosses used to speak. The senior speaks to the junior, or junior speaks to the senior. Sir, we are going ahead to for attacking the enemy. Over. He says over at the end, right? Why over is said at the end? So the next person can understand that the message is over. Again, over every time it's there. Same thing over here. End of the message. There is a line called as end of the message. Beyond this, there is no message. So up to that point, this issuing bank and this advising bank will take the printout of this document. It is received through technology Swift. It will take the printout and it will then courier it to the seller. Courier, post, anything. Okay. Send it physically to the exporter. This bank will take advising charges for this. What is advising charges? Kindly note, advising charges over here means advising. Courier charges, simple, because it has taken some efforts, printing it, checking the authenticity, checking the completeness of the document. It has taken the efforts. So these efforts need money. Nobody works for free. So this bank will collect advising charges from this seller. It will give the document and collects advising charges. Now the question over here is, if the advising charges are not paid, let's say they are not paid, okay? They are not paid by the seller. Suppose if this seller says, exporter says, I don't want a LC, give it back. So now what will happen? If this seller does not pay, then this bank is in trouble because it has taken all the efforts. What about the commission of this bank or charges of this bank? So these charges are to the account of the issuing bank. These charges are to the account of the issuing bank. If this guy doesn't pay, the advising bank will collect the charges from the issuing bank. Okay? Got this point? Now I'll clarify regarding this revocable LC and irrevocable LC, because these are also two important questions which come to you. Okay? Revocable versus irrevocable LC. Okay? So what is revocable? Revocable versus irrevocable. What is revocable versus irrevocable LC? Very important term. Under UCP, only irrevocable LCs are defined. Revocable LCs are not defined under UCP. Only irrevocable LCs are defined. Now what do you mean by this? Irrevocable and revocable. Let's take simple example. What happens? This issuing bank issues the LC. Now pay attention. Issuing bank issues the LC. It has issued the LC. LC is issued to this person through Swift. It has reached this person, this advising bank. From here it has reached the seller, exporter. Now what happens? This exporter has received the LC, physical LC, authentic document, physical document it has received. Now this seller is confident that I will get the payment. So what will happen? This seller will start manufacturing the goods. This seller will start manufacturing the goods. Obviously, suppose if I tell you, let's take one example. I'll give you some order that you prepare 1,000 white chairs, plastic chairs, and give me. So when will you be confident? When will you start the production? You will start the production only if you are confident of the payment from my side. If you know that I am not paying, I am a regular offender, or I don't pay the payments, you will not make any, you won't make any this production as such. You will say, leave it. First give me the surety of payment, then only I will make the start the production. Same thing happens over here. This exporter says, I don't trust any of this buyer. Once he receives this LC, Then the exporter says, yes, now I am confident that the bank will pay. So now he will start production. This exporter, he or she, he'll start the production over here. Okay. Now let's say the same order is received, 1000 white chairs. Imagine 1000 white chairs with the logo of this buyer. 1000 white chairs with the logo of the buyer. Okay, the order is received. Now this person starts manufacturing the chairs. Some 1000 order is there. Now what happens? By some 800 chairs are prepared. Imagine 800 chairs are prepared. Complete. They are in the factory. Now they are to be sent. Now what happens? In the meantime, this issuing bank sends another SWIFT. Kindly note, another SWIFT. That see, this LC is cancelled now. This buyer does not want these chairs. This buyer doesn't want these chairs. LC is cancelled. You keep the goods at your place only. You have not given the goods to me, so I won't give you any money. Means you have not sent the documents to me, you have not sent the goods to the buyer, so we won't be giving you any money. The transaction stands cancelled. Imagine these 800 chairs prepared by this person with the logo of that buyer. What will he do? Nobody else will buy these chairs because everyone wants their own logo. What will this seller do? These shares are a dead investment for him. Loss. So in this case, what happens? This LC can be cancelled anytime. Okay, by the issuing bank. Anytime. Without consenting anyone. Has it asked anyone? No. It feels we have to cancel the order, so cancel the order. This LC is called as revocable LC. This LC is called as revocable LC. Okay, revocable. Now what is irrevocable then? Irrevocable LC means, see, if this issuing bank wants to cancel this LC, it has to take the consent of the beneficiary, main beneficiary, and all the parties, other parties also. Advising bank, if there is any, or if they have a stake in this. See, anyone who has a stake in this, suppose if this LC is cancelled, who will pay the advising bank charges if this person is not paid? So all these things have to be taken in consideration. So this issuing bank cannot cancel the LC without the consent of any of the parties, means all the parties. All the parties need to give the consent that, see, yes, you can cancel the LC now. This advising bank will give the consent only when it has received its advising charges. This beneficiary will give the consent only when his losses are recovered. Otherwise, the LC cannot be cancelled. That LC is called as irrevocable LC. Irrevocable LC. Kindly note, irrevocable LC means what now? Irrevocable LC means the LC which cannot be cancelled without the consent of all the parties involved. Okay? So this is how the LC flow works. Right now the LC is with the exporter, beneficiary. Okay? Done? Understood everyone? A dash framework will translate organizational strategy into appropriate functional level goals which can be tracked and monitored at the right levels and frequency to deliver predictable improvement in metrics like ROA and thereby valuations. So which framework will help the bank to achieve the ROA? See, all these things are okay, simple logic. In exam, you have to first remove the scrap from the problem. Remove what is not required. Simple logic is which framework, and it will help you to achieve this ROA. Simple. Which framework will help you to achieve the ROA? That's what the question is. Profitability based performance management, business based performance management, revenue based performance management, and asset based performance management. All of you will think everything is correct. What's wrong in it? So frequency and deliver predictable improvement in the metrics like ROA. Now for this you need to first understand the meaning of ROA. Okay, ROA you have to understand the meaning, return on assets. Once you understand the meaning and full form of ROA, then immediately things become easy. Return on assets. So asset based performance management. Simple, isn't it? For that you should know the meaning of this ROA or full form of this. So the answer is this, asset based performance management. If you want to get into the metrics like ROA, what is ROA? What are my total loans and what are my total returns from that? Interest part. So that's basically ROA. Got it? To improve ROA and reduce variability in the performance, banks need to take forward-looking windshield-based approach to performance management rather than backward-looking rear-view-based, mirror-based approach. This would include which of the following framework? So, forward-looking approach. See, understand the question first. Do you want a forward-looking approach or do you want a backward-looking approach? That's the only question. Do you want a forward-looking approach or do you want a backward-looking approach? That's the only question over here. Yeah. A SMART. What do you mean by SMART? Specific, measurable, achievable, relevant, and timely. KPI framework and hierarchy for each business. Linkage of ROI targets to lower level financial goals, lag indicators, and operational parameters, lead indicators, and mapping them to the organizational hierarchy. Improved linkage between ROI improvement and the compensation and reward structure, and all of these. Pay attention to the question first. Observe these options also. SMART. Specific, measurable, achievable, relevant, and timely. Full form of SMART. This full form can also come separately in the exam. Specific, measurable, achievable, relevant, and timely. So do you need these elements? If you want to measure the performance of any bank, do you need these elements? Obviously, you will need it. SMART technique. So this is true. Linkage of ROI targets to lower level financial goals, lag indicators, and operational parameters, and mapping them to organizational hierarchy means giving specific targets to specific persons, to a level-based person. So do you need that? Obviously, your regional manager will have higher targets than you, isn't it? Because the regional manager is controlling the region. You are in the branch. So hierarchy based. So that is also right. So this is also true. Lead and lag indicators. Understand the meaning of lead and lag indicators. That is also important. Lag means what? Which will give you the solution or the analysis after the thing has happened. Lead means it will give you the solution or analysis before the thing happens. What can happen in future? Lead. This is also called as back testing and stress testing. Okay. So here ROI linked to the lag indicators and lead indicators. So that is also true. Improved linkage between ROI improvement and the compensation and reward structure. Target based, simple, target based. You do this much, you will get this much. You don't do this, you won't get it. Should we do the same in the banking? In fact, it is done in the banking. Right now also it is done in the banking. Okay, so the answer is all of the above. This is the right answer, D, all of the above, because all of them are compulsory if you want the bank to grow, isn't it? In the final phase, starting in the 90s, the government set up Narsimham Committee to manage the major reforms including liquidity standards in the banking sector. Which of the following is not the recommendation made by the Narsimham Committee? Kindly note, Narsimham Committee was an important committee in 1991. This committee, because of this committee, whatever banking we are seeing today, the speed, the private banks, the competition, it is because of this committee. Earlier, before Narsimham Committee, the Narasimha Rao government, okay, that opened up the economy. Before the Narasimha committee, the banking was very sluggish, very sluggish. Now the banking has changed a lot. So, which of them are not the recommendation? Regulation of interest rates, reduction of CRR, reduction of SLR, opening up of the sector for the private and foreign players. What was not the recommendation? Kindly focus the question. Not the recommendation. Narasimha committee was actually against this. So you want not. Narasimha committee was against this regulation of interest rate. It clearly said that RBI should come out of this job of regulating the interest rates. Before that, if you see, banks were given the FD rates also by RBI. FD rates also. Loan rates were given, but FD rates also by RBI. Means RBI gave literally the loan rates and FD rates to the banks. So Narasimha committee was against this, and this was not the recommendation. Remaining three were the recommendation: reduction in CRR, SLR, and opening of the sector for private banks. Among the below mentioned ratios, which of the following is not a part of common profitability ratios? So profitability, which of them is not the part of profitability ratio? Now for that you need to first understand what are the types of ratios. Ratios are of three types mainly: profitability, solvency and turnover. Okay, profitability, okay, second is solvency, and third one is turnover. TOL, write it, turnover. These are the three main types of ratios in ratio analysis. Profitability has 5 types of ratios. Okay, PE ratio, PE and this EPS. Okay, gross profit, net profit, and overall profitability. These are the 5 ratios in profitability. PE, EPS. Okay, so PE, EPS, gross profit, net profit, and overall profitability. Got it? Next, now which of them is not? Which of them is not? Kindly note, not a part of profitability. So 5 ratios I gave you regarding profitability: gross profit, debt margin, operating margin, and return on assets, return on sales. So which of them are not the part of profitability? Gross margin, gross profit ratio, it is there. Operating margin, operating profit, it is there. Overall profitability means operating. Return on assets, again it is there. Debt margin is different. Debt margin is not the right answer. It's not the part of these 3 ratios. Okay, it's actually, you can relate this to debt equity ratio, but that will be the part of debt equity, that will be the part of solvency, long-term solvency. Remaining 2 I'll explain you whenever some topic comes. Okay, so the answer is this. Required answer is this. Debt margin is not the part of your profitability ratio. Got it? This is not the part. So got it? Debt margin is the answer. Debt margin. Okay? Among the below given, which of the following actions to be taken for implementing the strategy objectives? Strategy objectives, okay? Implementing the strategy objectives. So, long-term strategy. To build a benchmark issues by issuing significant volumes and take advantage of the liquidity premium. Difficult words, isn't it? Elongate the maturity of the debt portfolio. Build a balanced maturity profile and supply along the yield curve, and all of the above. Strategy means you are thinking of long term. Whenever you are thinking of long term, The first question comes in mind is yield curve. Yield curve is something which is very important for long-term survival of any bank. So obviously this answer will be there. Build a balanced maturity profile and supply along the yield curve. Elongate the maturity of the debt portfolio. This is also one of the important strategies. If you have the loans of longer duration, okay, loans of longer duration, and similarly deposits also of longer duration. Not too long, because deposits too long is always a risky part. If you have it linked to the repo rates, then it's okay. But deposits in our country as of now, we are not in the repo rate style of deposits. Loans we have repo rates. So always the more longer you have the loans linked to the repo rates, the better it is for the bank, isn't it? So this is also elongate the maturity. That is also true. So now if two are true, obviously the answer will be all of the above. But for that you will have to check first whether this first one is also true. To build a benchmark issues by issuing significant volumes and take advantage of the liquidity premia. If you are having a liquidity, huge liquidity you are having, means you are having excess funds. Take advantage of that. Liquidity means what? The bank is having excess funds. So if I am having excess funds, I will lend it at a lower rate. So take advantage. All of the above. Correct? D is the answer. Which are the reinforcing pillars of Basel II revised framework? Minimum capital requirement, supervisory review, market discipline. A and B, B and C and A, B and C. See, Basel II revised framework. So which are the pillars? Is it minimum capital requirement, supervisory, market discipline? This is the easiest question for CAIIB level. This is the easiest question for CAIIB level. Think over it. Let me see. This you have done it in your JAIIB also, isn't it? So the answer for this is all the three. All the three are important. All A, B and C. Okay, all the three are important. In fact, Basel III also has the same ones. Only in Basel III what you have, everywhere you have the word enhanced. Enhanced. Everywhere. Here also, here also. Basel III has only one word which is added, that is enhanced minimum capital, enhanced supervisory review, enhanced market discipline. Pillars are same. Okay? Which of the following stress testing techniques specifies the shocks that might plausibly affect several market risk factors simultaneously if an extreme but possible event occurs? So, which will give you all the events occurring at the same time? All the events. It can happen. Repo rate is going up, then there is a war going on, GDP is going down, your bank is facing the problem internally. All the things can happen at the same time. So, simple sensitivity, scenario analysis, maximum loss and extreme value theory. Which one will give you the scenarios of various market risk factors, several market risk factors simultaneously? Many of you will get confused over here between this and this. Or some of you might think this also, maximum loss. Okay? Maximum loss also, because some of you might think maximum loss, all the things coming at the same time, so maximum loss. But it's not the answer. Maximum loss is not the answer. EVT is also not the answer, because EVT is different. EVT is not all the things coming at the same time. EVT is basically the market crashes like never before. That's called as a tail concept. So this is also not true. The true is this one. Scenario analysis. various scenarios you have to consider and take various options into consideration. Various points can happen. COVID can happen, your interest rates can suffer, there can be a war between various countries. All the things can happen. So that's why scenario analysis is the right answer. Scenario. And in that also, in scenario, you have one basic method. Means various scenarios are considered over here. Okay? Means all good and bad scenario. What is scenario basically? You are basically combining various elements. One name in that is Monte Carlo simulation. Monte Carlo is one of the best methods for scenario. Okay, you have a lot of questions on Monte Carlo. Kindly note. Monte Carlo. Monte Carlo simulation. One of the maximum asked question in the exam. Okay? Read this. Which of the following statements is or are true? Which of them is or are true? Assets and liabilities in the trading book are held until maturity. You want correct one, sir? Mark-to-market system is followed in the trading book. Derivatives are held for trading in the market or over the counter are not the part of the trading book. Derivatives that are held for trading in the market or over the counter are not the part of the trading book. Trading is subject to adverse movement in the market prices until they are liquidated. So these are the four options. Which one of them is correct? Think over it, everyone. Assets and liabilities in the trading book are held until maturity. Is it so? Assets and liabilities in the banking book are held until maturity. So this is false. Mark-to-market system is followed in the trading book. True. What is mark-to-market? Mark-to-market means notional profit or loss. Suppose if I purchase, let's say a Reliance share today, example I am giving, a Reliance share or any company share. Let's say I purchase it at 2000 rupees. Then tomorrow I am not going to sell it. But tomorrow if the price goes down from 2000, it goes down to let's say 1900. Am I selling it? No. But I have a notional loss of 100 rupees. So if I have this notional loss and if I am in the options market or if I am in the futures market, then I'll have to pay that loss from my pocket, from my savings account. That is called as mark to market. The reverse is also true. If I buy it at 2000 and tomorrow it goes to 2100, I am not selling it. But the difference between the same is given to me. This is generally done in the futures market. Futures is also always mark to market. Okay? Derivatives that are held for trading in the market over the counter, market or over the counter are not the part of trading book. What are the types of derivatives? One is in the market and second is OTC. There are only two types of derivatives in banking. One is ETC, second is OTC. Exchange traded, and second one is over the counter. So if both are not there, what is mentioned over here? Derivatives that are ETC or OTC are not the part of the trading book. Then what is trading book? What is trading book? Trading book means anything. It's also called as a proprietary book. This is also called as a proprietary book. Proprietary means what? Here I am buying the share, buying the stocks, shares or commodities or bonds for my own profit. Own profit. I as a bank want to earn the profit. So that's why I am buying it. So derivatives are held for trading in the market or over the counter are not the part of trading book. So that is false. That is a part of trading book. Okay? So 2 is correct up till now. Trading book is subject to adverse movement in the market prices until they are liquidated. What do you mean by this word liquidated? I'll give you a simple example. Again, the same example. I buy a share of, let's say, Reliance or any company. I buy that share. So, up to what time will I be concerned about the price of this company? Suppose if I buy it at 2000. So, I will check the prices daily or weekly or whatever frequency it is. Whether what is the price today? 2000 I had brought. Is it 2200, 2300? Is it 1800? Is it 1700? I'll check the prices. But up to what day will I check? Suppose if I sell the share after, let's say, 5 days, sell that share. I had purchased at 2000, now I have sold it at 2200. I have sold it. So after that, will you check the price again? Unless you have to buy it again. Forget the buying part. But will you check it with the risk factor that whether it is going up or down? You will not check because you have already sold the share. That is known as liquidation. So you will always check the price, or it is always subject to market movements or market prices, subject to you have not liquidated it. So 2 and 4. 2 and 4. This is the correct option. 2 and 4. Again, see this question. Very important one.